You would,
shareholders
yes.
to consent.
You would need all of the shareholders to consent when you have a significant change in ownership like that, yes. And that's even if some of the shareholders had the same interest before and after. Because you can have some shareholders whose percentage interests don't change at all. They still need to consent. Okay. Part of that, I think, is because, and part of the reason for that is, remember that for the closing of the books election where there is a termination of a shareholder's interest, that is a statutory rule. So Congress has said you only need consent of the affected shareholders. The other closing of the books method is regulatory. Little bit less authority behind that. And so in some ways, I think, for practical reasons, because all of the shareholders can be affected, but also I think because you need to put a little more oomph behind these things when it's regulatory, when you don't have quite as much authority. You get around that by saying, well, all the shareholders have to consent. So everybody's consented to it, you're done. So there are a couple of reasons for that. That is a difference though. One's regulatory, one's statutory. It does change the degree of authority there, right? Okay. Other questions? And this is just specific questions on what we've covered. You know, and we will still go through the other materials. No, everything tends to generally make sense, or maybe your questions are not yet formed. They're still coalescing. Yes?
Are you going to post any more homework solutions?
I will be posting everything else there is to post, which is these questions, the solutions to these questions, and the solutions to all the others, except for the homework you handed in.
Sometime tomorrow?
I'll try to do it tonight before I leave. Okay, I'll try to make sure to get them posted. So, anything else before we look at questions? Okay, well, let's look at some of these questions then. Okay. So let's see here. So this, these are some of the questions that have already been posted. These aren't the review questions. These are the weekly homework questions. I said it was going to be windy. It's just, I said gusts up to 85, I heard this morning. That's insane. Okay, so let's just walk through some of these. If there are specific problems on any of them, we can dig into them more. So individual A owns 100% of the stock of Corporation X, and Corporation X owns 90% of the stock of Corporation Y. Okay. So let's see if we can draw that. Okay. So can Corporation X make an S election? Can that entity make an S election? Well, it's owned by an individual, right? We know it has less than 100 shareholders. I would guess that it only has one class of stock, because even if it has multiple classes of stock, it only has one shareholder, so it can slice and dice it however it wants. Ultimately, it looks like it's got one class of stock here, because there's only one party getting the economics anyway. So it looks like that works. As long as A isn't a non-resident alien, would seem to be an eligible shareholder, we do have the issue of, well, is X an insurance company or something like that, but nothing to indicate that it is. Does it look like you can make an S election? Yeah, seems like it could. There used to be restrictions on whether or not an S corporation could own stock in a C corporation. those rules, they got rid of those rules. There used to be limitations. You could only own like 20% of the stock of a C corporation. Then it was 80%, and now it's whatever you want. So ultimately here you'd say X, sure, it looks like X can make an S election. What about corporation Y? No, doesn't look like it because it's got a corporate shareholder, right? Now, I mean, if it was 100% owned, maybe it could make a Q sub election. But since it's only 90% owned, it doesn't look like it can make an S election there because it's owned by a corporation. Now, what if Corporation X acquires the other 10% of Corporation Y's stock? Well, if we go from 90 to 100%, that's the Q sub issue, right? As long as X is an S corporation, Y can elect effectively to be an S corporation by electing to be a Q sub. Okay, it's the same basic treatment, although remember, if it's a Q sub, they're both treated as one corporation for federal tax purposes. You don't treat them separately. Now let's look at some of these. So M Corporation has a single class of common stock owned 50% by each of two brothers. Okay, one class, two individual shareholders. Corporation has paid dividends in each of the past 5 years. However, the dividends have not been paid equally to the brothers in each year. Due to different financial needs, they take different amounts in different years, with the understanding that they will even things up in the long run. What implications does this have for an S election for M Corp? What could be a problem here?
Classes.
Classes of stock, right. Notwithstanding that this corporation has a single class of stock, it says it only has one class of common stock. Notwithstanding that on paper it's got one class of common stock, it's not acting like it has one class of common stock. It's acting like it has multiple classes of stock. So that's an important point, that you're not just going to limit your review and limit looking at this issue. You're not going to limit yourself to the paper. You need to look at the reality of the situation. That often is a problem, particularly with S corporations. It's a problem because you often have, it's small business. It's folks who are not usually tax savvy. You might have 2 or 3 friends who happen to form an S corporation years ago, and they've done this because, frankly, this is what makes sense to them. These 2 brothers, this is what works. You know, brother number 1 needs money in year X, brother number 2 needs money in year Y. You just distribute what you need when you need it. But the problem with that is it looks like a second class of stock. The government's got a pretty strong case that it is a second class of stock.
Wouldn't it be a problem for partnership also if the distributions had no economic merit?
No, actually for a partnership it's all right. For a partnership, as long as the parties have agreed that the distributions can be handled this way, you're fine. By definition, any distribution has some economic basis. I mean, it is economics in the purest sense. You're getting money. You're taking money off the table from the partnership and it's now in your pocket. You can use it for something else. So it is the purest form of economics. Now, if the issue is, well, it's a 50-50 partnership, we're allocating equally between the 2 partners, well, that's okay also, as long as you follow the tax consequences. For example, if the partnership maintains capital accounts in accordance with 704B, liquidates in accordance with those capital accounts, and you know it has an unlimited deficit restoration obligation, it would meet the substantial economic effects safe harbor, and you could do this all day long. You can make distributions whenever you feel like it.
So you could do it based on marginal tax rates?
Sure. You have
As
no
long
problem
as
with
it's
that.
tracked.
You can absolutely do that in a partnership setting. The trick is you just have to make sure that you follow it all the way out, in the sense that if you make these distributions, ultimately, if you've distributed more to one brother than the other during the operational period, then on liquidation,
Right.
you would expect that the brother who has not gotten the distributions will have a much larger capital account and will be entitled to a lot more money. And so ultimately, that's where it balances out. And that's why a partnership, you can do that, you can be much more flexible. I mean, with these guys, you tell them, make it a partnership, make it an LLC, you get all the benefits. And that's really what's at risk here is the second class of stock issue. Now, if we look here, so N Corp was formed several years ago, but has never issued shares and has been completely inactive. Let's see. Okay. Never issued shares, been completely inactive. It has filed annual California franchise tax returns on a calendar year basis, paying the minimum franchise tax. On September 12, 2008, N Corp issues shares with the plan of beginning business in October. If N Corp is to be an S corporation, by what date must its election be filed? So, when do you start counting the 2 months and 15 days?
Date of formation.
Not necessarily. It's the earlier of the date the S corporation has assets, does business, or issues shares. The earliest of those three events. In this case, it appears that the earliest of those three is September 12th. So you would expect that you would say, all right, so September 27th, October 27th, November 27th. So you would expect you would need to elect by November 27th to be an S corporation in order to be an S corporation as of September 12th. How would your answer to A change if the corporation had originally issued shares of an incorporation but was otherwise inactive, and on September 12, 2008, the shareholder opened a bank account in the corporation's name with the intention of beginning business? Well, you've got a problem there, right? I mean, yes, on September 12th, you've opened a bank account, so now you've got assets in the S corporation, and you're going to do business in October, but you issued shares on formation, which was several years ago. You needed to elect then. You needed to elect back then. So what you can do is either form a new corporation to do this business, to maintain it, or to in which to house this enterprise. That way, you'd be able to look to the date of formation and issuance of shares currently. Or what you could do is defer the election and not elect S corporate status until January 1 of the following year. Either of those options would work. You do find this to be a problem. Sometimes folks will form a corporation with the idea that they're going to make it an S corporation, and then they don't get around to it, and they change their plans, and then they come back to it later. Well, you need to figure out when they issued shares, because that often is the date that's going to trigger issues. Okay. P Corp is a calendar year C corporation. On March 1, 2008, it files Form 2553. Remember, that's our S corporate election form. What result given the following alternative facts? Okay, P Corp had a corporate shareholder whose shares were redeemed on January 31, 2008. Okay, anybody, any thoughts on what happens under that set of facts? So we got a C corporation. It's going along doing business, it's calendar year. And one day they decide, all right, we're going to elect to be an S corporation. Now let's just, for a second here, let's ignore fact A that we looked at there. Let's just say on March 1, 2008, you file a Form 2553. Well, when is that effective? File your election. Remember that your election, if you make the election within the first 2 months and 15 days, it is retroactive to the beginning of the year. But there's a requirement there, right? The requirement is that for that entire period of time, you have to have been eligible to be an S corporation. If you're not eligible to be an S corporation during that entire period of time, you can't have it be retroactive. What happens is it carries forward until the next taxable year, January 1 of the following year in this case, or 2009. So under fact A, you would not have an S corporation. It would be a C corporation through 12/31/08. It'd be an S corporation, assuming it's otherwise eligible. It would be an S corporation on 1/1/09, and no further election would be required. The election made in March of 2008 is good enough. It just isn't retroactive because you weren't eligible during the entire period from 1/1 through the date of the election. Right. Now, what about this other alternative here? P Corp has 3 shareholders who all consented to the S election. A 4th individual sold all of her other shares to the other stockholders on January 31, 2008, and moved out of state. This former shareholder did not sign the Form 2553 consenting to the election. Okay, who needs to consent to the election in order to have it effective retroactively?
Unanimous.
Has to be all of them, yes. It has to be everyone who owns stock during that retroactive period. Even somebody who bought the stock after January 1st and sold it before the date of the election. Because think about it, that person is impacted by the election. Rather than having the taxable income captured at the C Corp level, they're going to have it allocated to them as a shareholder of the S Corporation. So, in this case, again, the effective date of the election is 1/1/2009. So, okay, L Corp files a Form 2553 for calendar year 2008 on March 20, 2008. Will the IRS reject the election?
No,
No, it doesn't reject the election.
just for the next year.
And yeah, it's just not effective. They do not reject elections. They say, thank you very much. This is effective on 1/1/09. Can L Corp rescind the election after it has been filed? It can. It is possible to rescind the election. And in this case, particularly, you look at it and say, well, you filed it, it's not even effective until next year. You can rescind it.
That's different than a termination?
It's different because a rescission of an election
Before it goes into
is
effect.
before it even goes into effect, exactly.
Do they need unanimous consent to rescind?
Yes. I believe there's a regulation that goes to rescission, as I recall. Suppose new shareholders acquire L corporate stock after the election is filed but before it takes effect. Must they consent to the election? Thoughts, anybody? This is what due diligence is for. If you're the buyer of the stock, you would want to do your due diligence and find out that, hey, an S corporate election was filed, it's going to kick into effect 1/1/09. You're buying C corporate stock, but it's going to be an S corporation shortly. You'd want to know that, but you do not have to consent. Anyone who acquires S corporate stock after an election is made does not have to consent to the S corporate election. The election, it's just an issue of when the election is made, who needs to consent. Anybody who's a shareholder on that date, and anybody who's a shareholder during a retroactive application date. Okay? These folks are acquiring after the election is filed, but before it's effective. So it's an odd circumstance, but they don't technically need to consent because there's no retroactive application period. You know, the election's already there. Yes?
In A, okay, fine, they can't reject it, but let's say that they didn't have any assets, business, or issued shares.
Mm-hmm. If that would be the case, nobody would consent. You have to have shareholders to consent. Now, on January 31, 2008, T Corporation elected to be taxed as an S corporation for the calendar year beginning 1/1/2008. one of T's shareholders is a trust that meets the requirements to be a quist, by what date must the trust file its quist election if T's S election is to be effective for 2008? Thoughts? Think about it this way. In order for the S election to be effective as of 1/108, all of the corporation must be eligible to elect as of 1/108, which means it has to have all eligible shareholders as of 1/108 for the entire period. Okay. In order for the quist or potential quist to be an eligible shareholder, it has to elect to be a quist. There's a separate election that's filed. So if it has to elect to be a quist, what's the time period on the quist election? I hear 2 months and 16 days? Yeah. 2 months and 16 days. So if it's 2 months and 16 days, so the quist election must be filed by March 16th. 2 months and 16 days after the election is filed. After the effective date of the election. So that way the quist election is retroactive and it allows the S Corp election to be retroactive. If either one of those elections fails, the earliest you can be an S corporation is 1/1 of the following year. But as we talked about with elections, there are so many freebies on these elections, it's unbelievable. Late relief, for years it seems, for failure to make these elections timely. So don't sweat it if you get to day number 2 months and 17 days and you haven't filed the election yet. There's plenty of relief out there, you just got to look it up. Okay? What's the result of the trust files its quist election on May 1, 2008? Well, it's late. The quist isn't a quist as of 1/1, so that means the S corporation can't be an S corporation as of 1/1, carries forward to 2009. Okay, by what date must a quist election be filed if the S election is filed on January 31, 2008, is effective on January 1, 2008, and the stock is transferred to the quist on June 1, 2008? So the quist, or potential quist, doesn't actually acquire the stock until June 1, 2008. By when does it need to elect to be a quist? Does it need to be effective? Does it need to elect on June 1? It still has that retroactive application. You still have 2 months and 16 days to make your election. So with that period, you'd say June 1, July 1, August 1, 16 days, August 16th, 16th, 17th, one or the other. I'm bad at counting. So that would you would be allowed to have the quist election retroactive to June 1 at that point. And if it's retroactive to June 1, then it's an eligible shareholder. If you made that election late, then what would happen is it wouldn't be an eligible shareholder and it would own S corporate stock. Termination. Your S corporate election is terminated because your S stock is owned by an ineligible shareholder. Okay. Now remember with quists in particular, quists are often used in testamentary situations. So oftentimes with a quist, you get that 2-year window because transfer of S corporate stock to a testamentary trust is you get a 2-year period before you need to make an election or determine or dispose of the stock. You get a 2-year window. So you may be safe here anyway for at least 2 years. It depends on the situation and the terms. Okay, what about C? By what date must the quist election be filed if the S election is filed on December 1, 2008 to be effective on January 1, 2009, and the quist received the stock earlier in 2008? When does the S corporation need to qualify as an S corporation? Do you need to qualify on the first date that you intend to be an S corporation? Or do you need to qualify when you elect? Well, it would be a little odd, to say the least, if you had an S corporate election that was filed with a future effective date and all of the shareholders who signed were C corporations. It would seem a little strange, wouldn't it? I mean, the election is being made by folks who cannot own the stock, with the idea that they're going to transfer it to folks who can own the stock. So that's not the way it works. You can't actually do that. It needs to be effective. You have to have eligible shareholders electing. So since the Quist would have to sign on to this election, it has to be a Quist when it signs the election. So the Quist has to qualify as a Quist when the election is filed. Which would mean you'd go 2 months and 16 days forward from December 1st, 2008. That make sense? Okay. Okay, let's look at basis allocate. Well, any questions on eligibility? It's the least interesting of the classes. It's gotta be. I mean, really. So let's look at this next step, basis allocation of income and losses. All right, F corporation is an S corporation with a September 30 year end. T, a 20% shareholder, sells all of her stock to you on December 15th, 2007. How does T report her share of F Corporation's, of F Corp's income for the year beginning October 1, 2007, and how does she compute the gain or loss on the sale of her F shares? Okay. So it's an S Corporation with a September 30 year end. T is a 20% shareholder, sells all of her stock to you on December 15th. How does T report her share of F Corp's income for the year beginning 10/1/2007? And how does she compute the gain or loss in the sale of her F shares? Well, how do we deal with the allocation issue, right? What's that?
Per share per day.
Per share per day. That's our default rule, absolutely. So we would simply determine what 20% of the income was. We use a pro rata approach. That's our default. She can elect, with the consent of the other affected shareholder, the buyer, she can elect to use a closing of the books method. Either of those methods, she would arrive at an amount of income or loss allocated to her. You determine the gain or loss on the sale of the stock by first increasing or decreasing the basis for the allocation for the year. So you would first need to run through the impact of the K1, income or increase for income, basis increase for income, basis decrease for loss. And then you would need to determine the gain based on that recomputed basis. Okay? Don't forget to run the income and loss through for that last period before you calculate the gain and loss, because that does impact your basis. Okay, Allison, Ben, and Casey form a new corporation on 4/1/2008 with each contributing $1,000 for an equal amount of shares, and file a timely S election effective April 1, 2008, electing a calendar year. After initial disputes about how the business is to be run, Casey sells all of his stock to Ben on May 30 for $1,000. Ben dies on November 30, 2008. Pursuant to the terms of Ben's estate planning documents, the stock is transferred to a trust that qualifies as a Quist, with his wife as the income beneficiary for life. Corporation had the following income and losses throughout the year. With all the different months. How must or may the income and losses be allocated amongst the shareholders? Okay. What are our different options here? We've got Allison, Ben, Casey. So we know where are our breakpoints. We start at 4-1, and then we go to 5:30. That's one break point. And then we go from there, from 6-1 to 11:30. And then from 12-1 to 12:31, right? Okay. All right. So if we look at the totals, we've got a $15,000 loss here for April and May, right? Then we've got June, July, August, September, October, November, all together. So that's 2, 5, 10, 15, is that 35? I think it's 35. 35,000 of income for that period, and 10,000 of income for the final period. Is that right? 35, 5, 10, 15. Yeah, 35. Messy. Okay. So let's see here for a second. Cucumbers. So if we use per share per day, and let's just, for the sake of argument, let's just flatten it out, do the months, you know, rather than actually calculating the days. Make me do easier math here. So if we do per share per day, we know each of them gets an equal amount during each of these break periods. And so we'd say, all right, each of these should get 5K. There, and here, did I do that math right? I guess I did. It's a messy number. 35 gives us roughly 12K each. Roughly 12K. Roughly 12,000. And then the last period here, each one, if we're doing again per share per day, you get 33, 33, 33, 33, 33, 33, right? And you'd add those up. You add them up differently because remember here, C starts as, let's see, after the initial disputes, Casey sells all of his stock to Ben on May 30th for 1,000. So Casey's share goes to Ben after that period, right? So we're going to erase Casey's share, and we're going to put it up here with Ben's. Ben's getting approximately 24,000 there. We know Casey doesn't get any here because Casey doesn't own any stock. We also know Ben doesn't get anything here, right? Because Ben's dead. Sorry, Ben. QSST, which is Ben's wife, or widow in this case. And so we'd go 33, 33 there. We go 0 here, 0 here, 0 here.
You're missing 33, 33 on the third column.
I am, aren't I? Yes. It should be
6.
Yes. Thank you. I lost some money there. So this would be under a per share per day method. Actually, this would be under a closing the books method. You could approach it this way. Because under a closing of the books method, we're blocking each period, right? So each period is being blocked. You're allocating out. Notice that A, nothing's going to change for A in any event, because nothing ever changes for A. A owns 1/3 the whole time. So A gets 1/3 the entire time. B, the Quist, and C get impacted by this. So this shows what would happen under a closing of the books method. Under a pro rata method, we would simply add all of this up. 15 plus 35 gives us 20 plus 10 gives us 30. We'd say, all right, we have a total of 30. Well, if we have a total of 30, how would we allocate that 30 out? Well, we would do per share per day. We would say that Allison, for example, would get 10 because she would own 1/3 for the entire year, so she would get 10. We would look to Ben, and Ben would own, let's see, 1/3 for 60 days, 61 days, something like that, would own 2/3 from June through November, and then would own nothing in December. And we'd look at the Quist would own 2/3 in December, and then we would look at, and for 2/3 for 31 days, and then we would look at Casey, who would own 1/3 for 61 days. And what we could do then is we could just determine for each day how much of the total of 30,000 is allocated to each day. And then we would allocate it based on the percentages. So if there's, how many days are there? 365 minus 31 for January, 334, 28, 306, 31, 275, right? So there's 275 days, I think. So we could take the 275, we'd say 30,000 divided by 275. That's our amount per day, and that would be something. You take your amount per day and you just allocate it per day to whoever has the percentage for each day. You'd say, well, C owns 1/3 for 61 days. So you'd say 61 days times X times 1/3 equals C's allocation. Per share per day. It's algebra. Everybody loves algebra, right? No. Okay. Higher math, I know. This is why God made Excel. They can probably figure out the number of days from April through December faster than I can. I'm sure they can. So hopefully you can see the two different approaches here. Okay? And they drive different results. Okay? They're going to drive different results. At the very least, you look at it in just conceptually. Under a closing of the books method, C is allocated a loss, right? And nothing else. Under a pro rata method, C is going to be allocated income. 30,000 over 275. No matter what we do, this number is going to be a positive number. C is going to be allocated income instead of a loss under a pro rata method. That's a difference. And that's why I always say, if you're looking at closing of the books versus pro rata, there's winners and there's losers. You've got to know which one your client is going to be under each method and get the right method for your client. Okay? So understand the differences between these two, and they do drive different results.